Have you ever wondered why the prices of goods and services increase over time? Why does the same cup of coffee that cost $1 a decade ago now cost $2? Or why the price of your favorite book has doubled in the past few years? This phenomenon is called inflation. In simple terms, inflation refers to the sustained increase in the general price level of goods and services in an economy over a period of time. When prices rise, each unit of currency buys fewer goods and services. Hence, inflation reflects the decreasing purchasing power of money, a loss of real value in the medium of exchange within an economy. So, what causes inflation? Economists often categorize the causes of inflation into two main types: demand-pull inflation and cost-push inflation. In the case of demand-pull inflation, it's like a tug of war. When demand for goods and services exceeds the available supply, businesses may raise prices to capitalize on this situation. This could be due to strong consumer spending, expansionary fiscal or monetary policies, or increased investment. On the other hand, cost-push inflation happens when the cost of production for businesses rises. If the cost of raw materials or wages goes up, businesses may increase prices to maintain their profit margins. Higher taxes or regulations imposed on businesses can also lead to cost-push inflation. Inflation can be a double-edged sword, having both positive and negative effects on the economy. On one hand, mild inflation can encourage spending and investment, stimulate economic growth, and reduce the real burden of debt. On the other hand, high and unpredictable inflation can erode people's purchasing power, create economic uncertainty, and make life tougher for those on fixed incomes. So, how do we manage inflation? Well, this is where central banks and monetary authorities step in. By using various monetary policy tools, such as adjusting interest rates, reserve requirements, and open market operations, they aim to control inflation and stabilize the economy. However, it's important to remember that inflation rates can vary across different sectors of the economy and can impact individuals and businesses differently. Depending on factors such as income, assets, and the ability to adjust prices or wages, the effects of inflation can be quite diverse. In conclusion, inflation is a complex economic phenomenon that affects us all in one way or another. It's a balancing act, where too much can harm the economy, but too little can stifle growth. Understanding it is key to navigating the economic landscape and making informed financial decisions. So next time you notice the price of your purchasing power, well, it's a question that's not just relevant to economists, but to everyone who uses money, which is, let's face it, all of us. Inflation is a phenomenon that directly impacts the purchasing power of money, essentially eroding its value over time. When inflation occurs, it means the general price level of goods and services is on the rise. What this translates to is each unit of currency, be it $1, a pound, or a euro, buying fewer goods and services than it did previously. Simply put, the same amount of money can now purchase a smaller quantity of goods or services. Let's explore this concept with an example. Imagine you have $100 today, and the inflation rate stands at 5% per year. This means that in a year's time the general price level is expected to increase by 5%. So the goods and services you could buy today for $100 would cost $105 next year. This implies that after a year, your $100 would have the same purchasing power as $95 today. Therefore, to maintain the same level of purchasing power, you would need $105 next year to buy what $100 could buy today. As inflation persists over time, the impact on purchasing power intensifies. If the inflation rate remains at 5% per year for a decade, prices would double approximately, reducing the purchasing power of $100 to around $50. Inflation affects different individuals and groups in a variety of ways, depending on factors such as income, assets, and their ability to adjust prices or wages. For instance, retirees relying on fixed incomes may struggle to maintain their standard of living as the purchasing power of their income dwindles. Conversely, individuals who can increase their incomes or adjust prices, like businesses or employees in high-demand industries, may manage to offset the effects of inflation to a degree. To safeguard against the erosion of purchasing power caused by inflation, individuals and businesses often resort to measures such as investing in assets that appreciate over time, like stocks or real estate, diversifying their investments, or adjusting their wages and prices to keep pace with inflation. Governments and central banks also play a crucial role by managing inflation and maintaining price stability through monetary policies, like adjusting interest rates and controlling the money supply. In summary, inflation is a powerful economic force that influences the purchasing power of money. It erodes the value of money over time, meaning the same amount of money can buy fewer goods and services. The impact of inflation becomes more significant over time, affecting different individuals and groups in various ways. To protect against inflation, individuals, businesses, and governments employ various strategies to maintain purchasing power and price stability.